Okay, I see people are joining us. Welcome. We'll get started in just about a minute as people come into our session today. Thank you, folks, for joining us. All right. Very good. Well, we'll get started. Thank you, everyone, for joining us. My name is Michael Thompson. I'm a partner and senior wealth advisor here at Copperleaf Financial in Vermont. And I'm very excited today to have our guest, Weston Wellington from Dimensional Fund Advisors in Texas. And Weston is joining us from Austin, Texas today. First of all, a little bit just to refresh your memories about Copperleaf. We are a fee-only financial planning firm, wealth management firm here in Vermont. And we practice what we call evidence-based investing, which we've been doing for a long time. Dimensional is one of our core partners that helps us implement client portfolios in a way that allows us to align with our evidence-based approach. Weston Wellington has been with Dimensional Fund Advisors for nearly 30 years. We were talking about that earlier. He joined the firm in 1995. Weston has a bachelor's degree in history from Yale University, and really is an expert in sort of the history of the financial markets. And that's one of the reasons I wanted Weston to join us today, to help us put the markets and world events and inflation and other things in context and help us put that in perspective. So I'm going to turn it over to Weston, and Weston is I think going to start off with a little bit of kind of market history or history of how we maybe putting some events in context. So Weston, I'll turn it over to you, and then maybe later we can dive into some questions.
Great, thank you, Michael, and thank you all for coming today. What I thought I would do, particularly in light of the rather alarming news events we're all seeing these days, is have a trip down memory lane, so to speak, and review events from the past 50-odd years that were certainly alarming at the time for many investors, and see what it can tell us about how we should go about facing our views on investing with our personal portfolios when we're confronted with disturbing headlines. And I'd like to preface this by saying our firm, Dimensional, believes, along with a significant number of well-known economists and other researchers, that for most investors, trying to outguess all the other investors who are reading the same headlines you are is more often than not an exercise in frustration. And perhaps some of that evidence will come through in what I'm about to say. So we're going to start off somewhat arbitrarily in 1970. I did this a bit on purpose because it was not a particularly auspicious time to be starting an investment cycle, which will follow through for 50-odd years. At the time, in 1970, we had the sharpest downturn in stock prices since the Great Depression. Although it's often referred to today as the forgotten bear market, because it was followed only a few years later by an even sharper downturn in stock prices, precipitated by rising oil prices and long lines at gasoline stations, turmoil in the White House, plunging economy, rising unemployment and inflation. Needless to say, stocks did rather poorly during that 73-74 period. And even when they began to recover in 1975, it still seemed like we were on shaky ground, at least in some of the nation's major cities. Fast forward to 1979, it's been a decade of ups and downs for stock prices, but not a lot of real progress. And Business Week comes out with their now famous, or perhaps infamous, Death of Equities cover story. And it's not surprising to understand or appreciate why Business Week took this viewpoint. When the cover story appeared, the Dow Jones was at roughly 875, right about where it was 15 years earlier.
Wow.
Now, granted, you got some dividends along the way, but this is presumably no one's idea of a buoyant stock market environment. And the gist of the argument was, according to Business Week, that inflation was destroying the stock market. But perhaps more importantly, this wasn't some temporary cyclical phenomenon. This was a permanent state of condition. And as a result, equities, in their view, were so-called dead, and they're never coming back. So overall, what was the decade like for an investor in stocks relative to risk-free treasury bills, we'll call as an alternative? Well, if you'd started that decade with $100,000 in your portfolio, invested all of it in the S&P 500 stock index, reinvested all of your dividends for 10 long years, you wound up not losing money, but you made less money than your neighbor investing in risk-free treasury bills. Hence, not surprising, Business Week's gloomy assessment. Well, the next decade starts off on a rather inauspicious note. I wonder how many of you might remember the so-called Silver Thursday incident in March of 1980, when the Hunt brothers had tried to corner the silver market and wound up losing huge sums of money when they couldn't pay back their loans to brokerage firms. And the market suffered a dramatic downturn when investors were worried they were going to bankrupt most of Wall Street. But markets recovered. And I'm going to mention this issue because it repeatedly comes up over the last 50 years. Here we have an early case of worries about having an excessive level of debt, not just in our country, but in other countries around the world. Prices recovered rather smartly in the mid-'80s, but then we had a devastating stock market crash. And at the time, many observers claimed that this one-day stock market event had permanently changed the landscape of Wall Street. Well, I would argue that all that had really changed is that we had set a new record of sorts. We had telescoped a conventional bear market, meaning a downturn of more than 20%, into just one single day. And then we were back to the normal ups and downs of stock market pricing. And throughout the 1980s, I would argue that there was this unease in the background that somehow American companies had lost their way. They were too focused on an emphasis on short-term profits. They weren't investing enough for the long term. And more nimble competitors, especially those in Japan, were slowly eating away and hollowing out our economy. Nevertheless, the decade as a whole for the 80s was a pretty good one for equity investors. Now our $100,000 has grown to almost $900,000, well ahead of our neighbor in treasury bills. So how did the 1990s start off? Not very appealing. We have another recession apparently about to start. We have war on the way, apparently, and government apparently paralyzed to do anything about either. As the armies began to gather strength in late 1990, many investors were very agitated about what might happen if war actually broke out. So January 1991, January 17th to be precise, that's what happened. Do we remember what happened in the stock market the day the missiles started to fly toward Baghdad? We had the strongest upsurge in stock prices since the snapback from the 1987 crash. I'm still looking for the one person who predicted what the market would do that day. Yeah. Then later that year, we began to hear an argument we're still hearing echoes of today, suggesting that by any sensible measure of valuation, stock prices relative to earnings, to dividends, to book value, they were so far above their long-run average, this couldn't possibly be a good time to be investing in stocks. And then later that year, this book published by an economist and a Fortune 500 chief executive argued that in just 3 years, due to all the excessive borrowing, the US government would be bankrupt. 1992, what was the economic assessment like? Well, according to Time magazine, we're having the longest period of sustained weakness since the Great Depression. Many investors are always concerned about leadership in the White House. This is Barton Briggs pictured here. Barton was a very colorful fellow, probably one of the most widely followed global investment experts at that time. And he's here on the cover of Forbes magazine with a bear costume signifying his negative outlook for the stock market. Well, why is he so negative? Mr. Biggs said he had a confession to make for readers of Forbes. I voted for Bill Clinton for president, and I made a huge mistake. Bill and Hillary are a disaster for the US stock market. Get your money out right now. Well, 1993 was a decent year for stocks. 94 was neither up nor down, basically flat. And 95, starts off on another great note, very strong year. Then in October of 1995, Joe Granville appears in the pages of Barron's Financial Weekly. Mr. Granville had a number of very accurate market timing predictions in the 1970s and early 80s. Now he tells readers that we are about to approach a rerun of September 1929. A devastating market crash lies just ahead. And it's only a matter of weeks away, at the very most, months away. No, the weeks and months go by, there's no crash, prices go even higher. And the chief investment officer for a major insurance company tells us he's never been more negative on the outlook for stocks in his entire investment career. Prices go higher still in 1997. Money magazine chimes in. Now is the time to take the chips off the table. Maybe by some miracle you had resisted all these suggestions to fiddle with your portfolio, and you had remained with whatever you thought was a sensible allocation to stocks. So what happened the next year, 1998? First half of 98, prices go even higher. They're up another 16%. And then along comes August of 1998. Now, it wasn't literally true, it just felt that way at the time, that every single day in the month of August, we had another version of the anguished trader photo appearing in the newspaper. The Russian government had defaulted on their debt at that time, leading to almost a domino effect around the world. So now you're reading your month-end August statement. It's early September. Not very pleasant reading. Your year-to-date gains have gone. You're looking at a loss year-to-date of about 1 or 2%. Except now, what are you reading? This isn't some ordinary stock market correction. This is a full-fledged global meltdown. Markets are falling everywhere. No one seems to have predicted it. No one seems to know what's going to happen next. And the phrase we heard over and over at that time, this is unprecedented. Who in their right mind wants to remain fully invested in equities in an unprecedented economic or market environment? So here we are in the third quarter of 1998, wondering, worrying, how deep, how long, how painful is the crash of 98 going to be? Then somehow this financial hurricane 8 months later has disappeared. And now we have a new concern. It's our irritatingly attractive next door neighbors getting filthy rich investing in technology stocks. And not just our next door neighbors, the golf pro, the gal bagging groceries, everybody seems to be making more money than we are in the stock market. Perhaps because we sold all our stocks 2 years earlier after reading Money magazine. But it's not too late. According to Harry Dent, who looks at the world to a view of demographic trends, aging baby boomers and so forth. In this book published in 1999, he lays out a very appealing vision of the future. A golden era for investors is just over the horizon, he says, powered by these unavoidable demographic trends. The Dow Jones will skyrocket to 40,000 by the year 2008. So hold that thought. So we end the decade of the 1990s. It's been a very rewarding decade for equity investors. Now our 100,000 is closing in on 5 million, even farther ahead of our neighbor in Treasury bills. So hold that number in your head for a moment. So the next decade starts off on a strong note. Prices go even higher. And two different authors, sort of channeling the Dow 40,000 prediction, come up with this book. The Dow could be 36,000, but you don't have to wait for 2008 to roll around. We think the Dow should be 36,000 today, based on what they claim was the appropriate relation between stock prices and bond yields. They're still massively undervalued, they argued. Well, we now know the Dow went nowhere near 36,000 or 40,000. We had a rather dramatic downward trip first. Fortunately, we have the Market Survival Guide issue, courtesy of Money magazine. Notice how the happily married couple is now the grim-faced individual. Maybe she changed the locks on the door after too many day trading escapades. 2000 was a down year for stocks. 2001, even a greater downturn for stocks. 2002, the worst of that 3-year downturn. Not only are we getting a a crushing retreat in many technology stocks, but now we have yet another war apparently on the horizon. Not surprisingly, many investors have decided they've had enough of stocks and want to retreat to the safety of a bank CD. This is the headline in the Wall Street Journal the day after the market hit the low for the year in early October, October 9th to be precise. What does the news tend to look like at the very bottom of a market downturn? It tends to look pretty grim. That's why prices are so low. The reporter here asked a bank trust officer, what do you think? Is it time to buy? Stocks have come down so much. What was his answer? What are you, nuts? Look around you. The whole world's falling apart. This is no time to be buying stocks. And yet, just 4 days later, we saw one of the strongest rallies in stock prices since 1933. Again, I'm still looking for anybody who predicted it. Now, prices retreated back somewhat early in 2003. And with war, in the midst of another war, many investors decided they'd had enough and were, according to the Wall Street Journal at least, stampeding out of stocks to lock up safer returns and treasury notes. This headline appeared the day after the market hit its low for the year. Just before, prices went up another 39% by year end. So all these investors who were stampeding out of stocks missed out on rates of return that were there for the taking. But you have to stay in your seat. And it happened despite a devastating healthcare crisis at that time that appeared, according to some observers, it was going to bankrupt the entire global travel industry. And then we're back to the daily grind, worrying about the economy, worrying about oil prices that will inevitably go, and soon to the high triple digits, worrying about our friends making more money than we are in real estate, or maybe not making more money than we are in real estate, leading to a devastating financial crisis, a very stressful time for many investors. On top of which, we're also worried about or concerned with a new occupant of the White House who may have a very different vision of what the appropriate relation between business and government should be. Now, this is an instructive headline, courtesy of the Financial Times. This headline appeared 10 days before the market started one of the longest and strongest and most rewarding upsurges in stock price in U.S. history. There's no end in sight for this bear market. Well, that's technically a completely true statement. There's never an end in sight for any market downturn or any market upturn. We just don't know what the future holds. And perhaps a blue ribbon award for one of the worst market predictions in recent history. This op-ed writer claims that all of the recent weakness in stock prices can be attributed to the behavior of just one individual who happens to occupy the White House. I'm not suggesting anyone should abandon their political beliefs, whatever they may be. I am suggesting be very skeptical of your ability or anyone else's ability to apply those beliefs in a way that can enhance your investment results. Implement your political beliefs at the ballot box, not with your life savings.
Yep.
Here's the market headline the day after it bottomed in early March. A TV news reporter had interviewed Mr. Warren Buffett, chairman of one of the largest companies in America. He told the newsman reporter, the U.S. economy has fallen off a cliff. Well, who wants to argue with him? What the reporter failed to ask Mr. Buffett, are you buying any stocks for Berkshire's portfolio? The answer would have been, yes, indeed, I am. And as stock prices began to surge, sometimes dramatically, many investors were bewildered how stock prices could possibly go up in the face of such grim economic news. Even Alan Abelson, a wonderful guy, wrote a weekly column for Barron's for more than 4 decades. He'd seen every market cycle come and go. But even someone with all of his experience, all of his wisdom, he was caught completely flat-footed by the upsurge in prices in 2009, insisting in August of that year that this marvelous movie we've all been watching will run in reverse, and it was guaranteed. And this is a key advantage of being a financial journalist. You can use the word guaranteed as many times as you want. No one can touch you. So by the end of 2009, where are we? Well, recall at the end of the previous decade, our equity portfolio was at 4.7 million. Now we're at 4.2 million. So we lost $500,000, about 10% over a decade, despite reinvesting all of our dividends. What's the message here? We expect stocks to have positive returns every day, every month, every year. It doesn't mean that realized returns will be positive every day, every month, every year, or even every decade. It's just our best expectation. So as the next decade gets underway, what are we hearing? There's a great deal of concern that all of the turmoil and the efforts to improve the economy from the horrific financial crisis in 2008 and 9 have left us with major problems. Perhaps an unsustainable government stimulus that will somehow create new problems, perhaps bubbles that will burst in the near future, or will simply slip back into yet another recession. And as proof, we still had banks failing left and right. The US loses its AAA credit rating from one of the major credit rating agencies. Bloomberg tells us if you aren't worried about the massive debt we have, you aren't worried enough. There's nowhere to hide, according to The Economist. Martin Wolf, voted by his peers among financial journalists as the most gifted commentator of his time, tells us we're sinking into the great stagnation. We're worried about weak employment. And many financial journalists will agree that trying to time the market, figure out when to be in stocks, when to be out of stocks, most of them will agree it's an exercise in frustration. But sometimes they just can't help themselves. To Brent Aaron's here, it was so obvious that stock prices were so overvalued. The only sensible strategy at that time was to adopt some sort of timing-based valuation strategy. The former budget director telling us that 8 decades of excessive borrowing have bankrupted America. The economist telling us that whatever the cycles of the economy might be, the very long run potential growth rate is not the same. It's permanently lower. We have a steep sell-off in stock prices in 2014. Another steep sell-off in 2015, another one in 2016, and then a controversial new chief executive in the White House and controversial leaders in other countries. And some just arguing this upsurge in prices has lasted just too darn long. It has to end sometime, more likely very soon. And we're even deeper in debt. The end is near. The New York Times tells us in December of 2018, it's time to assume your crash position. Are you ready for the financial crisis? Dead ahead. Well, they were right. Well, for about 1 week at least. We had the worst week in the stock market since 2008. Bloomberg chimes in, the so-called Trump bump in stock prices is over and done with. And now we can anticipate the Trump slump. So here we are, anxiously worrying what this future might bring for 2019. How many people at this juncture, whether individuals or professionals, would have expected the stock market to give an average rate of return consistent with past history, around 10%? I suspect only a minority. How many people would have suggested the stock market would be up more than 20% for the year ahead? I suspect very few. How about an estimate that the stock market would return over 30% for the year ahead? I suspect almost no one. And that's exactly what happened. S&P 500 returned over 31% in 2019. I'm still looking for one person who correctly predicted it. Let me know if you've come across them.
Yeah.
So at the end of 2019, our $100,000 is worth $15 million, over 15 times our neighbors' terminal wealth and treasury bills. And the year gets off to a very positive start, it seems, new highs in various indices. And then as very distressing news of this mysterious virus becomes clearer and clearer, stock prices start falling precipitously. James McIntosh of the Wall Street Journal tells us as markets are plunging, history says this rough market could get a lot worse. And he was absolutely right. Well, again, at least for a week or so, stock prices fell at an even faster pace than they had during the October meltdown and during the Great Depression. And then just as quickly, out of nowhere comes a very strong stock market rally, the best in 87 years, flummoxing many market observers. How can this possibly happen when the news is so negative? Unsurprisingly, many investors were equally puzzled. How can stock prices go up? It's obvious that we're having an unprecedented economic downturn. The International Monetary Fund predicting the worst downturn since the Depression, a catastrophic drop in retail sales. The damage is going to be even worse. Who could have imagined, with unemployment in 2019 at a 50-year low, that economists could even consider a 17% rate just the following year? All the experts who were paid to do nothing else but study all the economic numbers, telling us the pain will last for years. Company executives chiming in, the agony is far from over. Time magazine telling us a global depression is along the way. And yet, the Standard & Poor's 500 registers an all-time new record high by August 18th, leading at least one experienced market observer to claim the market is nuts. And I expect many investors had similar reactions. So hold that thought for a moment. As the market climbs higher, there's still a lot of concern over what the election results may bring for markets, for the economy. As we all know, as a nation, we voted, and we voted in a new chief executive. And stocks had their best election week since 1932. Again, I'm still looking for the one individual who correctly predicted that Joe Biden would be elected president and that the stock market would have its best week in decades for an election. So by the end of 2020, now we're at 18 million. And we'll wrap up here with a quick review of 2021. Once again, the experts told us it would be at best a year of low single digits, many of them predicting a down year for the stock market, but it was a year of impressive double-digit returns, despite a very trying, challenging year for many of us all across the country. So remember our claim, or the claim we were hearing, the market was nuts in August of 2020. And then we have another unusual headline appearing less than a year later. The numbers on the economic rebound tell us it is without historical parallel. Many investors are under, and financial journalists, I might add, operate under the mistaken idea that the stock market functions, roughly speaking, like a thermometer, telling us the temperature of today's economy. That's not what it does. The stock market is a mechanism for aggregating opinions about what the future may hold. So it's not taking the temperature of today's economy. It's trying to estimate what the temperature will be a year from now, 3 years from now, 5 years from now, 10 years from now, and reflecting it in stock prices. So unsurprisingly, stock markets tend to go up before the news is unambiguously better. I think a useful way to think about it is that stock markets tend to go up when the news is still black, but just a little less black than the day before. So we wind up the end of 2021, our $100,000 has grown to 23 million. Were there challenges along the way? Absolutely. Did you stay in your seat? So I'll stop there. I'd be happy to open it up to any question about anything I've talked about, or perhaps things that maybe I haven't talked about.
Well, great, Weston. Thank you. That was an illuminating trip through history, to say the least. I really, really appreciate that. And I had written down some notes, really some headline words that I know are on people's minds these days. And not remarkably, I suppose, all of them were kind of covered in that trip through history. I wrote down recession, inflation, war, rising interest rates, the Federal Reserve, stock valuations. All those things are things that we see in the headlines today and that we hear are on investors' minds. And yet those themes have been pretty much constant and ebbs and flows over the last 50 years. Very, very interesting. And other than stay in your seat, which I think is certainly the big message here, what I'm wondering is, what else do investors do? So how do investors position their portfolios to be able to weather the storm, be able to stay in their seats and take advantage of these ups and downs? And oh, by the way, one of the things I did note in this is the financial media certainly has been able to draw attention to itself and probably sell magazines and newspapers and eyes on websites with all these headlines.
Well, in defense of financial journalists, if you go to the barber and ask, "Do I need a haircut?" you kind of know what the answer is going to be.
Sure.
If you go to a financial journalist and say, "Where do you think the market's going?" a financial journalist is going to give you an opinion. That's what they're paid to do.
Right.
Write something about it.
Yep.
So they will, if you talk to them after hours in the bar, they'll say, "I really don't know where the market's going, but I got to give it my best shot. I have an opinion." Right. And people are entitled to hear my opinion, and I do the best I can.
Absolutely.
So
yeah.
I'm not going to demonize them. They have a tough job to do, but your job as an investor is the tougher one, in my estimation. You have to take your temperature and come to some assessment of what kind of portfolio makes sense for your situation, given not just your financial needs and objectives, but your emotional temperament. Some of us are just wired differently. I always remember reading about an Army experiment where they'd spent a lot of money apparently trying to evaluate soldiers with all sorts of elaborate tests to figure out were they better suited to be posted to a hot climate or a cold climate, which one would they be less likely to have a problem? Yeah. And they discovered that it didn't make much sense to do all these elaborate tests. You could get just as good results by asking them, "Would you rather be too hot or too cold?"
Right.
So
right.
You can apply that, at least in some sense, to investors. What makes you more uncomfortable? You'll be uncomfortable in either situation, like being too hot or too cold. Which one makes you more uncomfortable? Yep. You have a whole lot of excess cash you could invest and the market's going up, or you have a big helping of stocks and the market is going down. Yep. Now, you're not happy in either case, but which one makes you more unhappy? Well, I know where I sit. Yep. I'm much more anxious if I have a lot of cash and the market's going up than if I have a lot of stocks and the market's going down. But that's just me. It may not be you. And part of the challenge in figuring out your risk appetite is perhaps engaging in some exercises like that.
It's exactly true, Weston. And I want to remind people, our attendees, that if you do have questions, you can enter them in the chat box, and we'll be happy to address them along the way. And we have some time. We can set aside some time at the end for questions too. Weston, when we work with clients here at Copperleaf, we really talk about risk in three ways. And first of all, planning is at the core of everything that we do. So all of our clients go through an initial and a continuous planning process where we really need to understand income and expenses, assets and liabilities, what their goals are, what their hopes and fears are, and so that we can align their plan and they're investing with their objectives. But when we talk about risk, we really think about it in three ways. The first thing that we look at is that based on their goals and objectives, their need to take risk. How hard does the money need to work to stay ahead of inflation and stay ahead of taxes in order for them to accomplish their objective? And then we look at their ability to take risk, which is really time frame. If they need to spend money on a particular thing next year, then their ability to take risk with that money is fairly low. On the other hand, if the objective for that pocket of money, that bucket of money is longer term, then the ability to take some risk is a little bit higher. And then willingness to take risk is sort of what you were talking about, which is what I call the stomach acid test. So if all other things considered, if at the end of the day they open their statement and it's down 30%, are they just not going to be able to stand it? And if that's the case, then we need to factor that into the portfolio as well. So that's one way we approach it. We've got a question here. Let me see what we've got. Very good question. Throughout the walkthrough history, Weston, you noted the return of treasuries, and this question says, what role do bonds play in an investment portfolio? I'll weigh in with my answer, but I'll throw that to you, Weston. How do you think about the role of bonds in the portfolio?
Well, bonds are, to my mind, the risk-reducing asset. I could have complicated the presentation by including multiple types of bond strategies, long-term bonds, corporate bonds, municipal bonds, shorter-term bonds. I just wanted to keep it simple for the purposes of illustration. And most people are familiar with treasuries, and there's no argument, hopefully no argument, that they're, at least on a nominal basis, not considering inflation, they are super safe. So they always represent kind of a default position. But that's the only reason I use them. It just was a simple way to draw a distinction between riskier equities. For a practical portfolio, I think you'll find that people like Michael, and certainly the overwhelming majority of advisors that we work with, they have some allocation to bonds, longer term bonds, although our research suggests that a lot of the fixed income focus should be on intermediate to shorter term bonds as opposed to longer term bonds. We find that the risk reward trade-off there, we think, is better suited for most investors with those types of strategies. Yep. And Michael would be happy to expound on all the details of that. But we have a very carefully thought out approach to fixed income, where we have a very, we think, impressive record of maximizing returns in fixed income, but without having to make any forecasts or acting upon some predictions about what the Federal Reserve may do or where rates may go or not go. Yeah. And believe me, interest rates are just as hard to predict as stock prices.
Yes. Well, and for that reason, we try to avoid the whole game of trying to predict. And instead, for us, the purpose of bonds in the portfolio is really stability. That's sometimes I call it the ballast in the portfolio. We're not looking for equity-like returns. We're really looking for stability and safety in the portfolio, and that's the role. So the right amount, what's the right balance of bonds, and what's the right duration and yield, what's the right approach to the bonds in your portfolio, that really comes down to each individual's goals and their overall plan. But you're right, Weston, the evidence doesn't show that we get a lot of extra benefit from having longer term bonds versus shorter intermediate term, and generally try to keep the credit quality high so that we can really focus on that safety element for the bonds in the portfolio. So good question. Happy to hear. With that in mind, I wonder, Weston, we know that I think tomorrow the Federal Reserve is going to be speaking, and the market, maybe has predicted what the Federal Reserve will do, but people wonder, what's the impact of rising interest rates or action that the Federal Reserve may have on our portfolio and on the future. Any insights on kind of the role that the Fed has played over history and how markets might have responded to the Federal Reserve?
Well, a couple of things. First of all, let me just kind of skip to something that was, if I had this slide in here at some point.
Well, inflation is a good topic, so I don't mind your
We'll come
spending
back
time
to
on
that.
too.
We'll come back to that.
that.
Okay, so can you see the date here? Hope not.
Nope,
Fed
can't see
poised
the
to
date.
raise rates, an end of an era. That was in December 2015.
Wow.
How'd that work out? Was
Yep.
it the end of an era? Apparently not.
Nope.
So even if the Fed has announced it's going to raise rates, and by the way, this is also a bit of a misnomer, which people like Professor Fama, who works very closely with us, are quick to pounce on. Is that the whole sentence, the Fed poised to raise rates, is actually not accurate. The Fed does not control interest rates. It controls one interest rate, singular, the Fed funds rate. Now, it may have an implication for what other rates do, but even if you know what the Fed's going to do, it doesn't necessarily mean you can predict with certainty what other interest rates will do.
Right.
It's perfectly possible, and it's happened before, that the Fed raises the short-term target Fed funds rate. Other closely related short-term rates also rise somewhat, but longer-term rates don't. Sometimes they go up, sometimes they go down, sometimes they change the same. So it's one of those things that may seem easy to forecast. Turns out it's a lot harder to forecast than many people realize.
Yeah. Yep. Let's talk about inflation, because I saw you had some slides on that, and boy, that seems like something.
Let's have a little quickie quiz here. Let's see if I can bring it back. So, what was the highest inflation rate in 75 years, over the last 75 years? What were the 2 years with the highest U.S. inflation? 1979 and 1980. Double-digit inflation rates in both years.
Yep.
What was the rate of return on the S&P 500 during those 2 years of the highest inflation in 75 years? Any guesses? Whoops. Forgot to put it in there. Okay, I'll give you a hint. It was 18% in 1979 and 32% plus in 1980.
Wow.
Two well above average years for stocks. What am I saying here? Am I saying, oh gosh, we should all root for higher inflation because it's going to bring us great stock returns? I wouldn't say that.
Nope.
But nor would I say, if you have a prediction of accelerating inflation that comes true, everyone should run for the hills, financially speaking, because stocks are sure to go down.
Right.
Maybe not. It's just one more example of the unpredictability associated with stock prices. And keep in mind, you're competing with all the other investors out there in your efforts to assign price tags to securities. They're all reading the very same headlines you are about anything. War, too much debt, too little debt, economic growth, inflation rates, and reflecting it in prices for all sorts of securities. So the notion that you can read the paper and come to a better conclusion reliably than all the other smart people reading the same newspapers, I just think that's a very unwise position to take.
Yes, I would say so. And yet, it's amazing how many believe that their reading of the future, their reading of the current situation is unique to them, and somehow not the same as everybody else's.
Well, there is a lot of. They did award the Nobel Prize in economics in 2002, I believe it was, to a gentleman who had never taken a course in economics and never taught economics. He was a psychology professor, David Kahneman.
Yeah.
And one of his key insights is that in human beings, all of us, for whatever reason, have evolved to exhibit persistent overconfidence. We think we know more than we do. We think we can predict the future better than we can. We think we're smarter than other people on average. And there's a rich literature in psychology, all sorts of various experiments. And I'm sure you probably are familiar with some of them. If you ask 100 people, do you think you're an above average driver? Well, the overwhelming majority say, well, yes, I'm an above average driver. Well, that can't possibly be the case. We can't all be above average.
Yep.
Some of us have to be below average. How many people say I'm a below average driver? Not very many.
Not very many.
And yet they're out there, despite mathematical definition. So because we're often, for whatever reason, we can perhaps argue that we have evolved due to evolution to be overconfident because it gives us the determination to survive under perhaps hopeless conditions. It doesn't really work well for us when we're trying to evaluate complex statistical problems that really require higher mathematics to solve properly. Kind of a long-winded way of saying we're not very good at forecasting. And we're easy prey for those who fall into the trap of thinking it's easy to forecast.
Yep. I wonder about, and I don't know, I don't want to put you on the spot with your data here, Weston, but with everything that's going on in the world right now, not that this hasn't happened before, and every situation is unique in its own way. But sometimes I hear investors say, oh my gosh, there's the only safe place to invest in the world right now is the US. Why would I possibly want to invest in Europe or Asia or other parts of the world? It just seems so risky. Any thoughts about that?
Well, I'm certainly familiar with those opinions, and I can certainly understand why they might make sense to some people. But let's explore this a little further. Anybody remember this book here? Probably not.
No.
This was a book, and there were probably a dozen books of this genre coming out in the late 1980s, essentially arguing that Japan has this marvelous combination of business and government. They work closely together. They're a very peaceful society, very highly educated, nation of strivers, very cohesive. They've got it all figured out, and it's almost small wonder that their economy has done so well, and by extension, their stock market. And the notion that Japan was somehow sort of in a class by itself was a very popular theme back then. And for people who are arguing today that I want to have all my money in the US, I acknowledge that. But let's imagine we were having this discussion in Tokyo in the late 1980s. And all of you folks are citizens of Japan. And I'm trying to make the argument that, you really shouldn't have all of your money in one country, even though Japan's done very well economically and it's done very well, investment-wise. I really think that there could be some state of the world, I don't know how, there could be some state of the world where maybe it wouldn't make a lot of sense to have all your money in your home country, Japan. I think you want to diversify. You want to keep some money in Japan, but have some in other countries as well. Yeah. Well, the audience might say, do you have any data to show us what the results have been? I go, well, yeah, I have some data, and the data going back as far as we have good data on individual countries back to 1970 shows that Japan is the best performing stock market in the entire world over that 20-year period. Says the audience. See, that's why we want to be here in Japan. We have the best economy, the best educational system, the best performing stock market. Why would we invest anywhere else? All I can say, I don't have any data to disprove your arguments. All I have is an intuition that there might be some state of the world where those things are no longer true. What's happened? The last 20 or 30 years, has Japan somehow been vaporized? No, they're still a peaceful, prosperous country. Has it been a rewarding place for investors investing in Japanese equities? Not particularly. Somewhat mysteriously, even, it's been one of the poorest performing markets for a long time. Will that last forever? I tend to doubt it. When will it turn around? I have no idea. Has the US been one of the best performing markets? Certainly has over the last 10 years. Should we assume that that will continue over the next 10 or 20 years? I think that's more of a stretch. I think there could be some state of the world where other countries outperform the US as they have in the past. Over the very long run, the US among developed countries is about in the middle due to stock market returns.
Yep. Interesting, and we certainly have more data on that. If people have an interest in digging into it, happy to share some of that with folks if they want to dig in a little bit more. As we kind of near the end of our time now, Weston, I'm wondering about stock market valuations. You touched on that a little bit in your presentation, but I can't tell you how many times over the last few years we've heard from investors that, oh my gosh, the stock market's never been so high. It's got to come down. It can't continue to rise at this level. We're at all-time highs. How can it go on? Any thoughts on that? Anything history can tell us about that?
Well, history does tell us that the market is at all-time highs rather frequently. I think if we look at something like month-end values for the S&P 500, don't quote me on this, but I think I'm accurate saying 30% of the time they're at all-time record highs. So again, it comes down to, if this is a concern, what do we do about it?
Right.
We're trying to come up with some formula, some valuation system that will tell us when prices are too high. But it's not enough to say prices are too high. You have to say, okay, when are they going to be inexpensive enough to tell me now you need to get back in? And that's where all these efforts tend to break down.
Yep.
You have to have two right decisions, when to sell and when to buy back.
It's true.
I mean, a good example would be Alan Greenspan delivered his now famous or perhaps infamous speech talking about where he floated this phrase, irrational exuberance. He wasn't making a statement that markets are in fact irrational. It was like he typically was a somewhat evasive, but he would just float the question, well, what if? What should the Federal Reserve do if it seems that investors are behaving amidst irrational exuberance? Well, people took that phrase and kind of ran with it, saying, oh, perhaps we are in an irrational era. Well, suppose you had sold stocks back in 1996 at year end, when he made that speech. When would you have gotten back in?
Right.
I suspect never, because they never went back down close to their long run average, for example. That's at least some observers suggested, well, that would be a good time to buy back stocks. Well, you're still waiting.
Yeah.
And meanwhile, you've missed out on a rather impressive cycle of returns.
Which is such an important point. We just got a comment from one of our participants saying they wish they'd had $100,000 and invested in 1970. And to your very point, to achieve those results over time, you've got to stick it out. You've got to be in the market and not try to experience jumping in and out. I mean, we've seen some data. I don't have it here to share, but missing a short number of days of returns over that period of time, I'm sure would have resulted in meaningful reductions in that overall return.
Right. I think one number that I recall, which may or may not be more powerful, because sometimes people think, well, I'm not, just missing a certain day here or there. You're kind of like cherry picking the data. But if you take like I think if you just missed out on the very best 90-day period over it was something like the last 20 or 30 years, a long time, you missed out on your terminal wealth was something like 30% lower. And we'll have to get the proper figures for it, but it was a very material difference just missing out on a 3-month period. Markets tend to deliver very impressive returns over very short periods. And then you have these long periods of sort of trendless activity. But again, if you aren't there in your seat when these out of nowhere rallies take place, those returns are much harder to come by.
It's true. And the other important point there is, when we talk about markets, there's not just one market. As you said, as you were referring to when you're talking about bonds, there's not just one type of bond. We have the European market. We have Asia. We can break down markets into many different components, many different asset classes even. And it's important to have exposure to all of those because we don't know where the returns are going to come from, and we need to be there. We need to be in those markets, properly allocated towards our own individual goals and plans to be able to realize those rewards and those returns long term. And nobody knows. Nobody can really predict.
Let me just also on this other investing outside the U.S.
Yeah,
some people might be a little bit surprised to know that if you want to invest in the U.S., you might be surprised. Investing in the U.S. to most people means investing in the companies I'm familiar with right here. Let's remind ourselves that when you invest in Chevron, yes, you're investing in a U.S.-based company. But when you're going down the street and buying your gas from the Shell station, it's the one I go here closest to my place in Austin, you're actually dealing with a company based in London. So if you want to participate in their revenue stream, you need to own London stocks. You want to invest in a U.S. company, Hershey's, great. You want to invest, let's see, Nestle's Crunch, that's a U.S. company. Oh, no, they're Swiss. This is a U.S. company. Well, Ivory Soap from Procter & Gamble, Dove is from a Netherlands company.
Yeah.
Many prominent U.S. brands, people are surprised to learn, are no longer U.S.-owned brands. Budweiser beer is no longer a U.S. company. It's a Belgian company.
Yep.
Alpo dog food, Purina dog chow, both made by a Swiss company, Nestle.
Yep.
Michelin tires and Bridgestone, that's so Goodrich tires and Firestone tires, both owned by foreign companies, Japanese and French. The closest supermarket to my farm in New Hampshire is over in Bradford, Vermont.
Yep.
They're owned by the Dutch.
Yep.
Captain Morgan's Spice Rum, that sounds like an American name. Yeah, maybe, but they're owned by the Brits. So on and so on. You can go on the long list of companies products that you and I often buy every day. If we want to participate in that subsector of the economy, if you will, we need to go overseas to own shares in them.
Yep. Well, thank you, Weston. We're reaching the end of our time. I want to thank our participants for joining us today. Pleasure to have you always. We have another presentation coming up in April. We have Larry Swedroe, my friend Larry Swedroe, and Sam Adams, who have a new book coming out on sustainable investing. We're going to be talking to them, both of them, in April about sustainable investing. And in the meantime, as we wrap up, our thoughts long-term are with the folks that are suffering in Ukraine. And I want to encourage everybody to help out if you can, and otherwise get in touch with us if you have questions about your portfolio or your planning, or how to approach, how to think about or put in perspective the issues that are on people's minds today. So we're here to help and answer questions and help people really get that perspective and think about their own situation with a long-term view. So again, thank you, Weston, for joining us. Great pleasure. This session will be recorded. It'll be up on our website within a few days, and we hope to see everybody again next month. Thank you very much.
All right. Thank you all for coming today.